Welcome to Real Wealth, Real Health, the show that empowers you with insights, information, and inspiration to achieve your version of financial wellness. Learn how to balance living a full life today with planning for the future. This podcast is brought to you by Alpha Investing, a real estate-centric private capital network that provides exclusive investment opportunities to its members. And now, here are your hosts, AdaPia and Daniel Coca.
Hello, and welcome back to another episode of Real Wealth, Real Health. This is AdaPia. Our conversation today is with Mr. Jim Richardson. Jim is a 35-plus year commercial real estate veteran who's had stints at CBRE and more recently at Alexandria Real Estate Equities, listed on the New York Stock Exchange under the symbol ARE. He served there as president and continues as a board member. Alexandria Real Estate has grown exponentially during his time with the company, from a startup to an S&P 500 REIT with a total market cap exceeding $20 billion. Personally, he is an active investor in real estate, in technology, and e-commerce companies spanning various product types and business configurations. His primary investment objectives are to be both opportunistic and strategic in portfolio development. Jim, welcome to the podcast. Thank you so much for taking some time to speak with us today.
Well, thank you. It's wonderful to be here.
Yeah, it was when we first met, when I came to San Francisco with our partner Fark from Alpha Investing, and I met you. Your experience and your overview and everything that you've accomplished in your life was so impressive to me, and especially your investing philosophy. So I was really excited that you agreed to be on the podcast, and we can dive into some of those aspects of what you've learned in your life professionally and also personally.
Great.
So I think that usually like the best way to start is if you could give our listeners an overview of what you do, what you did, and just like a quick overview about your experience specifically as an institutional real estate investor.
Sure. So my professional career has been 100% in real estate. Notwithstanding the past 10 years, I've deviated into some other areas. So I started right out of college in the commercial real estate brokerage realm. Began with what was then Coldwell Banker, which had a number of different iterations during the time I was there. It became CB Richard Ellis, Coldwell Banker Commercial, went public, private. But during that 15-year period is really where I kind of cut my teeth or learned the commercial real estate industry from the client representation perspective. So during that evolution, kind of an instrumental part of it was, so I'm here in the Bay Area. And when you start right out of school and know very little, the opportunities that are available to you are kind of de minimis. So you have to pick an area to focus on. And at that time, the early 80s, I focused in the biotech industry, which was really in its infancy. Genentech up here in the Bay Area was probably 5 years old at that time. They were the pioneer. And so there were not a lot of people spending time and focusing there. And so it was... in a sense, low-hanging fruit, although fruit that most didn't like the taste of at the time. So I started there and was fascinated by the industry. The people that I engaged with every day were focused on changing the world. They had a passion that you just don't typically see, and I was really drawn to that. And it was also a small network. So it was at that time, a lot of the people that were kind of running that industry were young, passionate, and again, a part of a small network. And so as they proceeded in their careers and had success, I was able to evolve with them and grow with them, and then ultimately represent them as their companies became bigger and bigger. And in that process, it became clear to me that there was a real capital void that absent the ability to fill it, was going to retard the ability for them to really pursue their science and solve these kind of life-changing, potentially life-changing solutions they were pursuing. And that the primary issue is that these companies were underfunded, mostly venture-backed, required very expensive facilities to do their science in, and were in a real estate world at that time with landlords that were reluctant to spend anything beyond a very nominal amount of investment for tenant improvements. So there's a huge funding gap. And so I battled with them to try to help resolve that over time. But essentially, this led me into kind of my second chapter of my professional career, which was to what was then a startup, Alexandria Real Estate Equities. And so I had been pitching to venture capitalists and other potential financial resources the need to try to fill this gap and the economic opportunity, and it hadn't gotten very far. So to make a kind of a longer story short, encountered these guys as they were evolving this concept to try to fill that gap. And ultimately left what was then C.B. Richard Ellis and joined Alexandria the month it went public. And at that time, I believe we went public with $175 million and 4 properties, and then just started this journey, which ultimately now that company so I was the president of that company for about a decade. I'm still on the board, but no longer in executive management. But it's evolved now to be the first and largest provider of scientific research space for life sciences industry, with about a $23 billion total market cap and 25 million square feet of operating property. So there's a lot that went on between then and now that maybe we'll get into in various aspects of this. But so in essence, my career started in the brokerage realm, and I moved to institutional investment side. And one kind of pivotal piece of that for me, as it kind of tells you how I think I've thought about a lot of things, is one of the things that frustrated me about being on the brokerage side was, as much as I enjoyed the client base and the process and the variety of each and every day, is that you don't make the decisions. You make recommendations, and you can be an extraordinary consultant, but at the end of the day, you're not making the final call. And while you don't have the accountability necessarily, there's, for me at least, there was a desire to actually be a principal. And so in addition to wanting to help try to solve this bigger issue about this capital gap, I also was interested at that phase of my life in being at the table making the decisions. So that's it in a very brief nutshell.
It sounds so much to me like a bit of timing, but also trust in understanding. Like you said, like you started at a time when very few people were willing to take a risk on biotech in the 80s. And so much of your experience sounds like you really were using, the word that comes to mind is opportunistic. And this is something that we've talked about opportunities come with timing, not timing the market, but knowing when an opportunity is available and also seeing a little bit into the future of where it could go. Would that be a fair kind of representation of being able to grasp an opportunity and do something with it?
I think it is. I think there's just a life cycle to pretty much everything, and so it's when that opportunity appears and at what stage you opt in, and is in kind of that part of my story that I described. I didn't opt in at the very outset. Although if you look at when anybody else opted in, I guess you would say I did. We were kind of the first in, but it took several years of being frustrated by the lack of ability to compel others to address it that kind of pushed me to go in that direction. And I have this kind of theory about entrepreneurship that I think particularly with the next generation, the next generation subsequent to my own, there's this sense that entrepreneurship is this lifestyle, this extraordinary lifestyle that offers autonomy, and self-expression and purpose and so forth, which certainly it can. But I don't think there's a very clear understanding about how hard it really is. I think most of us have entrepreneurial instincts. We're all kind of on some spectrum, and we have our own ability to accept and embrace a certain level of risk. But very few people truly will push all the chips in, and so that, I don't know what that percentage of the business population is, but I would suggest probably less than 10%. And so the key to me, and kind of answer your question about being opportunistic, is where do you fit there, and where do you feel comfortable embracing that risk? For me, I'm not a pure entrepreneur that does it at the front end, but I think I did there and can recognize early on where opportunity can have significant future payoff and enter at a point where I'm comfortable taking that risk. And so that's how I see that. And that's how I see a lot of the investing that I've done.
Yeah, one interesting thing that's a little bit of a coincidence that we're having this conversation today. I read this article this morning about Alexandria Real Estate being selected by Seattle to build this, 800,000 square foot innovation campus. And so it seems like the things that you were kind of putting in place, at the beginning of your career are, now still a big part of what you guys are doing today.
Absolutely. And it's been an evolution. The company started by acquiring existing cash flowing assets. And then over the course of time, as the market continued to develop and evolve and our capital resources grew, we became developers. And then ultimately, back in kind of the mid 2000s, made a significant strategic structural shift into doing large medical center oriented campuses. Fully amenitized. The unique thing about the life science industry is there's a real desire for these companies to be in clusters, to be around all of the necessary resources for them to flourish. And that's not true in other industries necessarily. Technology, as an example, there's not necessarily a desire to collaborate. In fact, there isn't at the same level. And so we recognize that. And so that evolution happened. And as a result, the company's done some major campus development in Cambridge, Massachusetts, and New York City. You mentioned Seattle, San Francisco, all around the Mission Bay area. So, yeah, there has been both an evolution and a recognition of the way the industry was evolving and maturing, and how to best respond and continue to be fresh and on kind of the edge.
Jim, in the context of your background, I want to shift a little bit into how you evaluate your investment opportunities and real estate personally, because clearly an institutional investor has different priorities, prerogatives, different capital base to work with. And you did that for a long time in this industry. How do you think about and evaluate risk and opportunities for yourself personally in what you do today?
That's a great question. I think when you're doing, and again, speaking from my own experience, I guess, when you're doing one thing 24/7, you need to be very focused and kind of narrow in kind of your daily operations. And so what you end up doing is accumulating and aggregating, but not really strategically managing. So at least from an investment perspective. And so that once you step, and you have different resources, as you mentioned, once you step back from that, you actually have, at least in my case, you have a lot more time to contemplate what your longer term objectives are, and then how that's going to impact the way you do what you do every day. And so for me, at that stage, the stage when I kind of shifted from executive management at Alexandria to where I am today, I was still relatively young, and I had and have a desire to continue to grow and learn. And so the biggest tension for me was between investing in things that I really understood and knew and had a predictable outcome, and investing in things that I was actually interested in and would learn from. And very quickly learned that investing in things that interest and intrigue you and that you can learn in is a horrible investment thesis if you want to actually have good financial returns. And so for me, it's been more of a blend. And the reason for that is that even though you may be a critical thinker and you can ask great questions and dive in deeply, if it's something that is pretty far afield from your own expertise, it's hard to know what questions to ask. And it's easy to make diligence mistakes and so forth. So over the course of time, I've come to a place where I'm doing a combination of those things. I'm continuing to invest in what I understand the best, which is real estate or stuff around the fringes of real estate. And then the stuff that I'm doing that's outside of that, that's intriguing and interesting to me, I'm limiting those to a select few and diving in deeper with them and committing to longer periods of time to stick with them. And so, you're the audience. It's an audience of one when you're investing for yourself. Essentially, when you're investing institutionally, your stakeholders are obviously different. Your resources are different. Your strategies and objectives are substantially different. I mean, at least in our case at Alexandria, we had a specific focused niche. Who and how you're competing really is a big part of how you do what you do. And so a lot of things that just don't really relate to putting together your own personal portfolio.
Right. And so yeah, I mean we've spoken about this, that your fringe investments are like way out there, like venture, kind of like venture investments. And when it comes to real estate, what's interesting to me about what you just described is I'm thinking, if I'm, let's say, a doctor or a non-professional real estate investor, and I don't know anything about real estate, how can I approach investing in real estate that's not fringe? It's not as fringe as, let's say, cryptocurrency investing or like way out there venture investing, where that's money that you don't necessarily expect back. But real estate is a different kind of an investment. It's not necessarily fringe. So if somebody's not an expert in it and wants to get into it, what would be a good way or some good tips from you to them?
Well, first of all, just to clarify, I may be on the fringe, but I'm not in crypto. So that would be, for me, that's beyond fringe from my understanding. I think one of my primary tenets is, notwithstanding what I said before about investing in stuff that that I didn't understand all that well and wanted to learn by, I did understand what those investments were. I understood what they were trying to achieve. I understood what I was investing in. I will never invest in something that I can't understand. And I'm maybe a simple man, but I can't understand crypto. So I've not ventured there. But I think that philosophy, I think, applies well to a neophyte real estate investor. Real estate's really not that complicated. You can financially engineer it to make it more complicated. And I suggest the more things get financially engineered, the less attractive they are, because the reason people do that is they're not attractive just as they're on kind of their core value. To me, you're investing in a hard asset, something you can touch and feel, something that has intrinsic value, something that has value that you can actually measure in a variety of ways, all of which are pretty straightforward, and that have an intrinsic value, presuming it's investment real estate, to a third party that wants to use that asset to extend and accelerate its own interests. So your ability to actually look at each of those components and determine whether or not they make sense to you and whether or not the value proposition makes sense, and then look at that and the basic return you're going to get and compare it to what your alternatives are. If you're not a real estate person, it will take you a little bit to learn what the primary risk factors are. But if you study a bit, it's not that complicated, and you can kind of figure out the volatility and variability of the risk of you getting that yield and compare it to other assets that you could deploy your resources into. I think where real estate, to me, gets where being kind of more experienced at it is essential to making good decisions, is when you get outside of, when you either get into something that is being financially engineered, where essentially the return is the result of some machinations that are not typical, or you're getting into almost an evolving or a new asset class. I was early on into distressed single family residential investing, and I got involved with a group that was doing that in 2009. That was a risk, and I think for a variety of reasons, I thought it was worth taking. I got involved in, and I'm not sure if we had talked about this before, but involved with a group that was converting virgin cattle ranching lands into almond orchards. And for a variety of reasons, that was new at the time and a risk. But those were both businesses that I could get my arms around understanding those aspects that I described, but they're much higher in the risk spectrum because they hadn't really been done before. And so it's a little bit of a long-winded answer to basically say, I don't think real estate is that complicated to understand if you just focus on the fundamentals. And then it's pretty natural and seamless to compare that to your other alternatives, the other asset classes where you can deploy your capital.
Right. Yeah. Thank you for that. That's very clarifying. And just for me to clarify, when I mentioned crypto, I was thinking I got into crypto back in like 2013, and I'm just letting it ride. It was like just like a tiny little bit of money. I don't really understand it, and I just played it like a gamble. But yeah, it's been interesting to kind of watch that. And the more complicated it gets, the further away I stay. It just, to your point, like I just, I have my 2 or 3 Bitcoins or whatever, and I just watch them like fly up and down, let them do their thing. But, we did speak about the almond orchard, and we also spoke about how that investment for you was long-term. And if you could hold that forever, because it was producing at some point, it was producing good returns for you. But then, if I'm not mistaken, that ended up selling. And is that how you came into our sphere of alpha investing? Is that right?
Indirectly, I would say. I maybe, and that's not how I came to know you guys, but that's how I came to think about what you do differently than I might have had I not been through some prior experiences. And so just several investments that I've made over the last 10 years in kind of this quasi cutting edge, in these quasi cutting edge areas, ultimately proved out. The theories proved out, and they were successful, and they generated great cash flow, which was the reason that I was investing to begin with, was to generate some long-term cash flow. But because they became as successful as they did, the general partner's incentives are to make sure it can hit all of the prescribed hurdles it needs to optimize the investment for both the investors and for themselves. And oftentimes that will motivate a disposition earlier than you would have hoped as an investor. And so that has happened to me now several times over the past decade. And while it's great to have a nice exit and a great return, a nice multiple, now you have to reinvest money that you had intended to be parked for the long term. And so as I started to look at other alternatives to try to get to what I was after, the alternative is to directly invest yourself, where you control the ultimate decision. That's a whole different challenge. And as I started looking at what Alpha was doing, it occurred to me, let me back up one second. So what I started to do with this cash that I was getting from these other investments was essentially short-term bonds. And I created ladders with my financial advisor to ensure that I always had some liquidity to invest as I saw, but I was getting, short-term, not great, but short-term returns, through a kind of this laddering concept. And so as I started to look at Alpha, it kind of occurred to me that I could do the same thing over the long haul on the equity side and do it in an area that I really understood. So as, maybe just to give you kind of an example of how I've done that to date, I'm not sure how many sponsored investments have you guys done to this point?
So right now we have investments in 40 different properties across 18 states with 9 different sponsor partners.
Okay. So out of those 40, I've probably done 7 or 8 of them. And I probably haven't looked at all 40 because I came in, there's been periods where I haven't been able to engage as fully. So let's just say, 35 of them I've looked at, I've invested in 20% of them. So I personally have diversified the stuff that I'm interested in investing in, whether it's geographically, product type, risk profile, sponsor, whatever. I've got my own kind of filter for doing that. And I've invested in, a handful of these, and each one of them, and probably every 6 months or so. And so I've essentially created the same ladder. So even though each one of those has maybe a 5 to 7 year time horizon, they'll be cycling in and out. So I'll be able to essentially create a fairly consistent cash flow stream as I aggregate those. And if one of them sells, I can redeploy the capital back and kind of continue to build. And so I'm not sure that everybody would look at it that way. But for me, it's a unique, there's not another way for me to do that other than maybe investing in a bunch of public REITs. And investing in a public real estate investment trust is different than investing in private partnerships with single assets. And so I've just found it kind of unique and refreshing because it gives me a chance to underwrite and invest in just the things I want to, almost like I'm picking individual stocks based on my own interest preferences and background, but also to sequence it in a way that I can somewhat control the cash flow. So that's how I'm thinking about alpha right now.
So Jim, you're a professional real estate investor, and not everyone in our network, meets that definition. But when you're looking at some of the projects that we're sharing, what are the things that kind of jump out to you in terms of, what you start evaluating first, whether it be the sponsor and their experience, or if you just kind of jump into underwriting the property, or the submarket? What does your internal underwriting process look like as a current and former professional real estate investor?
Great question. So my standard process is I will do a cursory review of an offering memorandum and determine if it interests me. And it's hard to tell you exactly what all those characteristics are, but for me over time, it's sponsorship for sure, the quality of the sponsor, to the extent I have the ability to understand the product and the market, quickly kind of summarize that. And then obviously returns, incentives, leverage. So there's a lot of, so I have a quick kind of filter that, it'll take me a half an hour, 45 minutes to review. And then if I'm interested, then I'll dig in a lot deeper. So taking alpha as an example, if I get to that next level, I will look at all the due diligence materials that are provided through the sponsor. I'll listen to those sponsor calls. Oftentimes, I already know something about the product or the market. I may look at some external resources, but what I don't do is just look at the yield, the projected yield, and make a decision based on that, because I've just learned over time that there's not necessarily a pro rata relationship between the level of the yield and the level of the risk. And so I want to, if something is going to, in the second year be producing 11 or 12% cash on cash return in a market where you're just not seeing that anywhere else, there's a reason for that. There's an embedded risk that you have to be willing to accept as an investor. It's just, at least at the point we are in the market cycle, I have seen very few deals that are, kind of off-market sourced that'll allow that to happen. And so I just dig into really understanding the fundamentals of the investment and how they're solving to get to that yield level that's being projected, and determining whether I buy it. I also typically like to understand why the seller's selling. In a market like this, oftentimes that's because it's just such a frothy market that a seller will just determine, I can't imagine getting better than this, and I'm going to get the best value I can get, so now's the time. if that's the case, then it's just a question of whether or not you believe that you can stomach that price. But oftentimes there's other reasons. And so I always like to understand that as best I can. And you might not get 100% of the real story, but if you probe a little bit, you can get a better sense for it. So I would just say that I have this kind of umbrella filter. If I'm interested, I dig in and I keep asking questions, and I'm almost looking to be convinced along the way not to invest. And then ultimately, if I get through my various concerns and doubts and feel like they have been adequately addressed, then I invest. It's kind of that basic.
Yeah. I actually have a question. Just want to dig in a little bit more on why the seller is selling, because sometimes you have an institutional seller, like a big institutional seller that we had on a recent multifamily project that we did, and then other times it's slightly smaller sellers. And is it an institution, like a large one, institutional investor will have different targets, and they might not want to squeeze every last dollar out of that sale. So can you talk a little bit about disposition strategy for a very large investor, and whether it does indicate market sentiment, or if it's something to be evaluated with a grain of salt as it relates to market timing?
Yeah, no, absolutely. I think for sure institutional investors have a variety of reasons why they dispose of assets. I would say it is not typical that they're doing it because they're optimizing. And when I talk about large institutional investors, I'm talking about public REITs, I'm talking about multi-billion-dollar asset aggregators. And while there are maybe some private equity funds that would just be trying to call the top of the market and sell, generally it's because there's been a strategic shift or a reallocation. And so most institutional investors have a strategy and a niche they're focused on, and your tactics within that niche will ultimately evolve as your strategy continues to evolve. So you could see an institutional investor, say a REIT, that at one phase of its growth, it is bulking up. It has to get to a certain size in order to get to a certain valuation that will allow it to sell equity in order to continue to grow. And once they get to that point, there's more scrutiny, and the objective is to narrow the focus, become more focused and an expert in specific areas. So you might then reorient to urban cores, or to the coasts, or to a certain class of product type. And a lot of the assets that you acquired on the way up no longer fit. And so the objective is to get fair value, but as importantly, the pace at which you can do that is pretty important. You need certainty of performance on the other side, and you need to be able to do this stuff quickly, because you're not just doing one. You're shifting a whole portfolio, and so you want to do business with people you trust and close. And so it isn't the number one priority that you get the top dollar necessarily. So that's a generic answer, but that's generally what I've seen with larger institutions. So when I talk about why is a seller selling, oftentimes that's the reason. Other times it may not be. It may be something different where it is an individual asset holder. I think you guys had one recently that I invested in that was kind of more of a distressed situation, and the sponsor that you brought in had more expertise than the seller, and so that story held together well for me.
So it's interesting because you said like the story, and I always find that really fascinating, because yes, it's an investment. Of course, and we're looking at analytics, and everyone should be looking at the numbers when putting together any kind of a portfolio. But so much of this is the story and a business plan and the people behind it. So it's still like people. There's just like when I worked in a hedge fund, when I worked in the public markets, yes, it's numbers, but it's also very much about psychology, and that's what moves anything. And so to me, as I learned more and became more involved in the real estate side of investing, I really found that the relationship aspect of real estate was paramount. It's huge. Like who the people are is even more important than in public markets, even though you might have one or two behemoths that can literally move the markets. But anyway, like the story, the business plan, the people, the relationships seems to me to be an extremely important part of real estate investing.
Absolutely. It's all about trust, and that's not just real estate. It's pretty much anything you invest in. And, that doesn't mean, so it's a balance. It's clearly a balance, because both sides have objectives that are not mutually exclusive, but you're not on the same side of the table, and so doing business with people that care about, on both sides, their long-term reputation, their ability to do business together in the future, as well as do business with people within each other's networks, is huge. And so, yeah, you just find, and I have found this for sure in my career, that your reputation has a long tail, a really long tail, and you have to constantly be aware of that in how you conduct yourself and how you choose who you do business with. Yeah, when I said stories, I didn't mean it in a way that kind of negate the need to have legitimate, substantiable data and intelligence, but you do have to get comfortable with the why, and you're not going to get there exclusively with numbers.
Yeah, of course. No, and that was at least to me was fully understood that there's the substantive part and the analytics, and also very much the story portion, because
Mhm.
that goes into, can a sponsor do what they say they're going to do, and
Exactly.
are they the right person? And so that's part of that story in that relationship building. And along these lines, I'm curious, because this, like you said, was a lesson that you learned in your career. Are there any other? I'm curious to know any other big lessons that you've learned in business. So just to shift a little bit more into what you've learned building a business. As an entrepreneur, we talked about that a little bit, but you went from entrepreneur to something also like very large in public market. What are some of the lessons about building a business that you learned?
This isn't, clearly, is pretty obvious, not rocket science. It just comes back to the people. At a kind of a really high level, do you have the right people in the right places at the right time? I mean, if I think back to the Alexandria experience, we were growing very quickly, but we were growing nationally. And so managing that from the West Coast was a challenge. And even if you were Superman, and you actually had the energy and stamina to do all that, you don't have the network. You don't have the relationships that we were just talking about. And so most essential for us, and I found this in all the other investment I've done outside the real estate realm as well, was getting those right people in place at the right time. I mean, that's a key piece of it too. You can have the right person, but if you're not ready for them, or they're not ready for it, you're going to create more stress and tension than if you didn't do anything. So anyway, so for me, I guess what I've learned over the years is that execution is huge. It's critical, and operational efficiency and excellence is essential. But it just does not happen if you don't have the right people, and you don't have a culture that is pretty well understood and defined, within which you decide whether you can embed those folks. And I will say that at the outset, I didn't fully understand that. That wasn't, it was much more, I'm very analytical anyway, but I was just much more inclined that way. Understand a market, go and get it. There's just a whole soft piece to growing an organization that if you don't get right, you will just be very frustrated. And I even in the investments, and I talked to a college class a couple years ago, on kind of my business philosophy and investing philosophy. And it forced me to actually go back and figure out why I do what I do or have done what I've done. And so I looked back at all the investments that I had been involved in over the past decade to find out what were the common threads to them, to the ones that succeeded and the ones that didn't succeed. And I there were kind of these core tenets that came out of that, and first and foremost was the people. If the company was run by people with integrity and character and honorable purpose, you had a good shot of success. There's some things I'll talk about in a moment here that are essential as well. But I also found, interestingly, that teams did better for me than individuals. So if you had a choice between a team that had those characteristics, integrity, honorable purpose, and character versus an individual, you had better chance of being successful with the team. And I think that gets back to humility and complementary skill sets and collaboration and all that stuff. Secondly, that team has a high level of competence. And maybe obviously that it has to be a compelling idea or a business plan that for me, that actually matters and can have some impact, not just kind of a Me Too thing that somebody's already done that you're just trying to get on the back of. And then ultimately something that, as I mentioned at the outset, that I could learn from, because if I wasn't engaged and interested and able to learn, then I wouldn't be engaged in the investment. And then to the extent I have anything to add of value that might help, it wouldn't happen because I wouldn't be engaged. So I found that in the investments that I had, that all four of those characteristics were strong. It did well. As they fell off, I did worse and worse. And so it kind of gets back to your original question about building a business. Those things were critical. And what I learned in kind of just in my experience of building a business, but then I started to invest, they just became expressed more clearly and frequently because I was seeing it happen over and over again versus just in my own business.
It's such wisdom. I think that's like one of my favorite words, and you really embody that in everything that you've done. And I wanted to ask you one last question. And you covered this a little bit, I think. How have your personal values and even some of your goals, how have those evolved for you through the life cycle of your career? And you mentioned at the beginning of that you left Alexandria early, but by no means have you retired to an island. You're very active. You're doing a lot, like you're, quote unquote, working. So I'm curious how your personal values and goals have evolved in your career, and how the life that you live today, how you live that life, still investing and learning and growing, but living a very fulfilling life.
Wow, that's the big question. So I entered an industry at a time during a generation that just had a whole different way of valuing success. I was a former athlete. Most of the people that were in the commercial real estate industry when I started there was a lot of those kind of type A former athletes, and there was a scoreboard, and it was pretty simple. It was how much money you made. And actually in the brokerage, I don't know how it's done today, but back then you actually knew how much everybody made because the manager would publish it, every quarter. And so that scoreboard was binary and obvious and objective. And so what happened to me and to probably many others is that the emphasis there was substantially outsized relative to what it should have been. And so, I'm from a generation that was, at least in the world I was in, it was focused on accumulation and aggregation without necessarily a whole lot of thought as to why. Maybe it was to have, more material wealth than you would have imagined, or to expend it on things. And so I think as I've evolved over time, it's become so obvious and clear that that's not very fulfilling, that there has to be a reason that you do that. And I don't subscribe to this kind of halftime theory, which is that you spend all your time, you get to a certain point in your life, and then you kind of just reverse gears completely, and then try to figure out how to have an impact. And I think that that was a popular theory back then, actually. And I just don't think that happens. It's not natural. It's an evolution. And so I guess what I realized during the process of being a part of building Alexandria and then moving into this next phase of my life is where I'm really most passionate is in kind of working with the next generation. But I don't think about it in a kind of a classic mentoring way that I've read about and heard about. I feel like I get more out of those relationships than I put into them. So there's kind of this, I call mutual mentoring that happens that just invigorates me. And so almost everything, we haven't really talked at all about kind of the specific investments I've made, but if I look at those, the people I talked about, that having to, be either teams or people of integrity, character, and purpose, they're almost always younger than me. And so there's just a kind of re-energizing and picking this curiosity that I have about so much that's nourished by that experience. So I would say that's how I've evolved. And now, everything I'm doing naturally has an element of desired impact. And I'm not, believe me, I don't want to overstate what I'm doing here, but if I don't feel like there's any meaning or that it matters, I just don't do it anymore. And so there's just a self-awareness, I guess, that you get with age, and it's part of a natural evolution. And where it really, I have 4 kids, they're all out of the house, but they're all millennials. And so I have such a connection to that next generation anyway. And so then when you do what I did, so I'm now on, I haven't looked recently, but between public company, non-public company, for-profit, non-profit, ministry, I'm on probably a dozen different boards, but every one of them, I'm actually really involved with the company. I'm not, I have very few passive investments. And so the tension I have is about this kind of life balance thing that I think a lot of us have, no matter how we're doing what we're doing. I guess my theory there is that, if you've heard maybe a lot of my bloviating about the spectrum, but I think there's a spectrum. I think I'm a planner, I'm a strategy guy, I'm a process guy, but I also know that my next breath is not promised. I mean, I truly believe that. And so it's my natural inclination to orient towards being overstructured and overplanned. And so my constant effort is to try to stay in the moment, try to be in the moment, because that's hard for me. It's much easier for me to go down this other pathway. So I think just recognizing that forces me to have a balance that would be easy for me not to have if all I thought about was planning for the future. Because, as I said, who knows? This could be it. So anyway, that's a long-winded description of my own evolution in this realm, and if you ask me 5 years from now, I'm sure it'll be different.
Yeah, I'm sure it will, other than the fact that you'll still be targeting meaning and purpose. I think that when you get into the realm of that self-awareness, you don't go back, because as you can tell that that meaning, it's like it just imbues you, and so you seek that meaning out. So if anything, I would venture to say that that'll still be prevalent for you. And it's amazing that you're on a dozen boards and you give them time. And I think one of the things that really stands out for me is that the planning part, is we should all be planning. Like, we should all be planning for our future. And you've found the way to do that and still be very present and be in the moment and live your life today, which is something really important. And it's also why Daniel and I started the podcast, was to talk about that. How do you plan for the future, but live and also live today, not but, and live today. So I think your description pretty much encompassed all of that.
And I just to clarify too, one last thing is the board thing. That's not like a goal and an objective. And I actually don't even, and I don't mean to say it in a way to try to impress, because I don't see it that way at all. It's most of those are just the best way for me to engage in, in none of those situations am I needed. It forces me to have a level of accountability to these things, because absent that commitment, my time would flow elsewhere. And so I just want to clarify that's not an objective. It turns out to be more of a mechanism to participate, and rather than an objective.
Yeah. Oh no, that's understood. And I understand that, because you said, like, coming from the generation that you came from, it was all quantitative. So I completely understand that. I know that we're running up on our time. So Daniel, is there anything that that you wanted to maybe close up with Jim? Otherwise, this has been such a wonderful conversation, Jim. Really, thank you so much for everything that you've brought here today.
Yeah, absolutely. Thank you so much, Jim. I think for a lot of the people in our network who are either new to real estate investing or are just kind of starting their journey, hearing your story, I think provides them with a good amount of guidance and just some things to think about as they plan for their futures, whether it be investment or otherwise. And so we're very appreciative for you taking the time with us today.
Oh, it's been a pleasure. Thank you, guys.
All right. Thank you.
Thanks for tuning in to Real Wealth, Real Health. We hope that you've enjoyed today's episode and found it both informative and insightful. We welcome all your questions and your feedback about today's episode, and especially we welcome your questions about specific topics that you would like us to cover. So shoot us an email at podcast@alphai.com. And if you have a moment, we really appreciate ratings and reviews, as it helps us grow our online community and our interactions with you. And we'll also be linking to a number of relevant articles on topics that we might have touched on during our conversations. Some of them are broad, some of them are technical, but we're always aiming to provide information that helps you better understand the mechanics of building this healthy financial foundation, especially if you're looking to do this with real estate.